Hello, I'm Laura McHarrie at The Hidden Edge with another tea break tip on how to use business models and tools to help you manage your growing business. Today we're looking at strategic tax planning. Whether or not you're growing your business, there are tax implications. The bottom line, tax dividends, is not the only thing that you need to consider. Growth adds additional considerations. Perhaps you're thinking about acquiring another business, or maybe you're investing in people, facilities, or product development. You may be entering new markets or diversifying to spread the risk to your core business. However, you are planning to grow, understanding the tax implications helps you to consider the best return on your investments. So first, let's have a look at the life cycle of a business and the tax implications. This business model is illustrating strategic tax planning prior to starting a business through to exit. It's a starting point for us to look at the different ways that you may consider tax planning for the future. We start with the business idea and the plan and the best business structure, and whether you need to be VAT registered immediately or not. We look at funding requirements and the tax issues around that, the tax implications of intellectual property and loss offsetting taxes. We'll look at tax relief, including R&D, capital allowances, and inheritance tax. Then as we become more established, we might look at employee shareholdings, investor tax incentives, and company pension schemes. There is the opportunity, of course, to expand or further expand, and we might want to do that through mergers and acquisitions, holdings companies, and import-export duties. And finally, we might want to consider tax restructuring for sale, capital gains tax relief, and the entrepreneurs and investors relief. Let's look at those in a bit more detail. What we have here is the checklist, the timeline down the side, the tax implications and the considerations, and then an opportunity for you to consider what the impact of each of those is like for you right now. H stands for high, M stands for medium, and L stands for low impact. Decide on the most suitable and tax efficient trading structure for you right now, and that can change as you develop. If you are an employer, you will need to pay national insurance for your employees on top of what they pay themselves. IR 35, self-employed and outsourcing issues. You're usually self-employed if you're your own boss and trade as a sole trader or in a partnership. HMRC may treat you as an employee, however, unless you can show features such as controlling what you do and how and when you do it, having more than one customer, bearing an element of business risk, having the right to get a subcontractor or employee to do the work instead of yourself. Watch out if you're a corporation and employ somebody as an outsourced freelancer, just to make sure you're covered with that. VAT-registered businesses charge their customers VAT on most supplies of goods and services, but can also usually reclaim the VAT on most purchases themselves. Businesses that are not registered do not charge VAT, but cannot reclaim the VAT they pay. Do make sure that if you are not VAT registered when you start a business, you consider your pricing structure for when the time comes when you do need to be VAT registered. Intellectual property tax efficiencies, for example, patent box. HMRC dictates that to be granted a patent, your invention must meet the following criteria. It must be something that can be made or used. It must be a new product. It must be inventive, not a simple modification to something that already exists. Directors' loans. If you are a director, you can take a loan up to £10,000 tax-free as long as it is paid within 9 months and 1 day of the financial year end and is not borrowed again within 30 days. Offsetting losses. Losses are treated differently depending on whether you're self-employed or a limited company. Business relief tax, including R&D. Spending on research and development, R&D, small and medium-sized businesses can claim R&D tax credits on qualifying spending at 230%. This means that you can set £230 off against your profits for every £100 you spend on research and development. Companies not yet in profit or not yet trading can claim a cash payment of 14.5% of R&D expenditure instead. Capital allowance maximisation, including enhanced capital allowances. You cannot claim the cost of purchasing or improving premises. Most other business assets are tax deductible through capital allowances rather than as an expense. In most cases, you write off a percentage of the asset's value against profits each year. There are 100% allowances for energy saving and environmentally beneficial equipment. Inheritance tax. Shares in a small business may be exempt from inheritance tax. There are some qualifying criteria. Employee share schemes. Limited companies can introduce tax-favoured share schemes for their employees. Approved schemes include share incentive plans, save as you earn, and the enterprise management incentive. Investor tax incentives, EIS, SEIS, VCTs. Investment made through various schemes offer tax advantages. Both the enterprise investment and venture capital schemes are aimed at boosting investment in small unquoted businesses. Company pension schemes. Payments into a pension scheme are an efficient way of saving tax. Bear in mind that such payments will then be locked in. Weigh up the possibility that the cash will be needed in the business. Sometimes a company that's having an especially good year will pursue a deal so that it can expense acquisition costs against profits it would have had to have paid taxes on. All of the added legal, accounting, administrative, IT, HR, and severance pay costs are deductible as ordinary business expenses, offsetting at least some of the costs of integrating the companies. Holding companies. There are many reasons to consider holding the shares in your trading company through a separate holding company, the main one being to safeguard the retained profits. Importing and exporting taxes. Import duties are levied on imported goods. In addition to import duties, you normally have to pay VAT. Tax restructuring for sale. Capital losses can be set off against capital gains from the same year. Any excess loss can be carried forward to set off against future gains. Payments of some capital gains tax can be deferred. If you sell something for more than you paid for it, you may have to pay capital gains tax. Individuals pay capital gains tax on any capital gains over the annual tax-free allowance. And finally, entrepreneurs and investors relief. Individuals may be able to claim entrepreneurs relief on the sale of any business. Of course, I must finish with a caveat. Do discuss your specific situation with a properly qualified tax specialist. Make sure that your accounting system shows how much tax is payable every month, and check that you're keeping all your receipts and invoices and other evidence that is required by law. Make realistic provisions for your future tax bills. Plan your cash flow so that when the tax demand arrives, you do have the cash to pay for it. Do go to the Hidden Edge website where you can download and request the templates, and whilst you're there, share your stories of what's worked well for you or maybe not so well for you. It's good to learn through other people's errors as much as it is from their good stories. So until next tea break time, enjoy the rest of this one.